Today's topic is how startups raise money. This is useful for people who want to start their own businesses, but it will also help you understand what stocks are and what it means to own part of a company. Before we begin, do you know what a funding round is?
I had to get lots of funding to pursue my PhD thesis, so I assume that startup funding rounds work the same way, and you just find someone to ask for a grant.
It's a little bit more complicated. Startups are new companies that are trying to expand their operations. To do so, they often need capital, aka lots of money early on to scale up their operations. So let's look at this example.
I have a great business idea. You know how everyone likes hot dogs, right?
Yes?
And hot dogs are in this totally lame cylindrical shape.
Okay.
Get this, I will make hot dogs in the shape of a SpongeBob.
In the shape of a SpongeBob. You mean a square hot dog? Are you sure that's a good idea?
Totally, it will make millions. Let me get started with selling square hot dogs. I'm going to call my super novel square hot dog company the Super Novel Square Hot Dog Company Inc. And I will pay $50 to register it in the state of Colorado. Wait, it's asking me for how many shares I want to issue. I think I should write infinity since I want everyone to share my hot dogs.
Not in this case. Shares are a claim to ownership of part of your company. I would recommend issuing 100 shares. And since you are the only person involved in your business for now, you own all 100 of them. So you own 100% of your company. This means that you get 100% of the voting rights and you will get 100% of the company's profits.
So I own everything. Unlimited power.
Let's not get ahead of ourselves.
My super novel square hot dog company has really taken off. Each day, I cook 10 square hot dogs at home and bring them to my old office. All of my old coworkers love them, and each person gives me $8 for a hot dog. Since the cost of the ingredients and the cooking cost for each hot dog is $3, I make $5 for every hot dog that I make. So I'm currently getting $50 per day. I would like to scale up my operations and buy a hot dog stand so I can sell even more hot dogs. The problem is a hot dog stand costs $3,000. And when I add in the cost of a license and all the cooking gear I need, I will probably need $5,000. But I just graduated and I'm totally broke. What can I do?
I can help. I am an angel investor, a rich person who likes to help early stage startup founders succeed. You, my good sir, have a fabulous idea that will revolutionize the entire fast food industry. Angel investors like myself give startup founders we believe in money in exchange for equity.
What is equity? You mean I have to have some sort of diversity, equity, and inclusion commitments in my business?
Do not worry. I care about money, not about equality. Equity is a share of ownership in your company. In this case, Super Novel Square Hot Dog Company Inc. I will happily give you $5,000 in exchange for 10% of your company.
How does that work?
Your firm has 100 shares, right? So simply give me 10 of them. Now you have 90 shares and own 90% of the company, and I own 10 shares and own 10%. Because I thought that 10% of your business is worth $5,000, I am valuing your startup at $50,000.
A small aside, people often talk about the value of a company as though it is something set in stone, but it really is not. Here, the startup was valued at $50,000 because that is what the investors in the most recent funding round believed it was worth.
This is great. With a square hot dog stand, I am now able to make and sell 500 hot dogs each day. Though my operating costs rose to $6 per hot dog. So I'm now making a profit of $1,000 per day, which is amazing. My partner, the angel investor, is entitled to 10% of this, or $100. And I get 90%, which is $900.
But let's not distribute our profits just yet. I propose we do the following. Let's hire someone to operate the stand and pay them a wage. Then you and I buy hot dog stands in 100 cities around the United States, and we make a fortune.
But buying that many stands and hiring people to staff each one of them would cost at least $500,000. Plus, we would have to do a lot of advertising and marketing.
Don't worry, I'm here.
Who are you?
I work at a venture capital firm called Sequoia Rare Pants Capital. We invest larger amounts of money in high potential startups. We'll give you $1 million in exchange for 20% of your firm.
So, how would that work?
Well, we issue an additional 25 shares and give them all to Sequoia Rare Pants Capital. Now, there are 125 shares in total. You own 90 shares or 72% of the firm. I own 10 shares or 8% of the firm. The VC owns 25 shares or 20% of the firm. And since they paid $1 million for 20% of the business, our startup is valued at $5 million now.
It's a deal.
Why would a VC invest $1 million in a company that makes square hot dogs? It's our job to recognize good ideas when we see them. I won't comment. Anyhow, because both the eccentric entrepreneur and his angel investor now control a smaller percentage of the firm than they did before, we say that they have been diluted.
What a success. Our business has now expanded to the entire United States of America. But now we have two new ideas that will require lots of investment. First, we want to expand to other countries, namely China, the European Union, India, and South Sudan.
Wait, the first three make sense because they are large economies, but why would you ever expand to South Sudan?
It's the world's newest country. Plus, I think they'll love the product. Secondly, we also have a brilliant new idea to launch alongside the square hot dog. You know how hamburgers are circular, right? Which is super drab and boring.
Please don't tell me you've invented a square hamburger.
Of course not. That would be stupid. It's a triangular hamburger. But to go global and make this product, we need at least $10 million in funding. Who can we go to? I know, a private equity firm.
Good afternoon. I hear you are looking for $10 million.
Indeed, we are.
Let me make you an offer you cannot refuse. You currently have 125 shares. How about you issue 75 new shares and give them to me? In exchange, I will give you the $10 million you desire.
So we have 200 shares in total. 75 of these go to the PE firm, so they get 37.5% of the firm. The VC firm has 25 shares, so they own 12.5% of the firm. The angel investor has 10 shares, so 5%. And I own 90 shares, so I have 45% of the firm. We are all getting quite diluted, but this will let us massively raise profits, so I think it is worth it. We have a deal. Amazing. My company is very well established and has expanded globally into Europe, Asia, and Africa. Our South Sudanese branch is doing splendidly. Now, the VC firm wants to exit their investment. In other words, they want to sell their stake in the business. You said we should do an initial public offering.
Indeed. Right now, our company is private. In other words, the shares are not easily traded. An IPO is like the funding rounds we already raised, except we sell the shares to ordinary people. So in other words, we issue a certain number of shares on a public stock exchange so that normal people can buy them. And then it becomes a public company.
Got it. And by normal people, you mean anyone who is not a startup founder, an angel investor, a venture capitalist, or a private equity person?
Exactly. Let's do the following. Let's do an IPO where we sell 50 shares to the public. 25 will come from me, and 25 from the PE firm. Although many IPOs involve creating new shares, which can be a way to fund the company, in this case, our IPO only involves existing shareholders selling their stake in the firm to the public. So no new shares are created. So now I own no shares in the firm. The founder still owns 90 shares, or 45% of the firm, and the angel investor still owns 10 shares, or 5% of the firm. The PE firm now owns 50 shares, or 25%, and the people who buy into the company after the IPO will collectively own another 50 shares, or 25% of the company, and I will exit with lots of money.
I still don't understand how this business has done so well. People really will invest in anything. What are our learning takeaways? Even I'm confused here.
When startups need cash to scale up their operations, founders trade away a percent ownership of their startup in exchange for cash. The amount of cash relative to the percent of ownership given away determines the firm's valuation. Typically, early stage startups will approach angel investors, slightly larger ones will approach VCs, established companies will approach PE firms, and very established firms will go public in an IPO.
Congratulations! You've just learned the basics of funding rounds and how startups raise money.